Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about cash and receivables. We've talked about how to control cash and reduce theft of cash using our financial accounting techniques. And then we started talking about receivables. We did some basic examples with accounts receivable, how to record initial sales and payments. And then we did some examples on how we get to record net realizable value with our accounts receivable. Then we took some time to talk about notes receivable conceptually. And now it's time, yes, to do the journal entries for notes receivable. I'm so excited. I love doing these things. So we're going to transition into a problem. Before we do, take a quick look at the concepts we reviewed last time. Now hopefully you were comfortable with all of these and the key concept that's wrapped up in there. But again, the idea with receivables is we're going to record the present value, what those future dollars we're going to get from whoever we've loaned that money to are worth today, and then we're going to have to do some adjustments over time so that we get from what we record today, our carrying value, to what we actually are going to receive from them at the end. And that's the process of amortization, as we get rid of a premium or a discount and get our carrying value, what the carrying value being what it's worth on our books, to its face value and what they're actually going to give us at the end of the contract. So with that kind of as a brief review, let's take a look at an example company. This is Jones Company. Jones has been offered the special opportunity to invest in a $60,000 3-year note receivable. The note will pay 10% annually, so they'll get some interest as they go, and then the full amount will be due at the end of the 3 years. Jones has an internal rate of return, meaning they expect to earn this much on all of their investments, of 12%. We want to make the journal entry to show the purchase of this note or the loaning of this money to the other company. Now before we can do that, we need to start off with the important information. And anytime I do a present value calculation, I always gather the necessary information. So we start with the face value, that's this amount, the amount we're going to get at the end of the period. Next, I want my stated rate, and that's the amount that it says it will pay. So that's this 10%. Now that I've got the face value and the stated rate, I can get the interest payment. And I'm going to do that by just multiplying. So 60,000 times 10%, they're going to pay 6,000 each year. Next, I need my N, so the number of periods that this payment will be made, and that's 3. And finally, I want my effective rate, and that's 12%. Now, before I go any further on this, one of the things I want to decide is this a discount, a premium, or par value note? Meaning, how are we going to record this? Well, the important thing here is the difference between interest rates. Jones can normally make 12% interest. This bond or note is only paying 10%. So would that be a premium or a discount? It would be a discount, because this number is less than what Jones can actually make. Now that I know that it's a discount, and I know my interest payable, I'm done with the stated rate. And I don't want to accidentally use it for something else, so I'm actually going to just kind of scribble that out. That's just me. I like to get rid of that number. I don't want to accidentally grab it. Like I said, you don't have to do it that way, but to me, that makes sense. So now, what I need to decide next is what's the present value of this note? What am I actually going to record it being worth on my books today? With the caveat, I know it's got to end up as a discount. So the way that we do this calculation is with a set of equations. So the present value of the interest, I always start with the interest, is the payments we're going to receive times the present value of an annuity factor for n periods at a given percent. That's my equation. To calculate present value actually requires this big formal equation. But we've simplified it and put it into a set of tables. So if you can figure out the factor, then you can just go to that table, grab that value, and you're good to go. So in this case, we're using an annuity table as opposed to a lump or single sum table. Annuity table means you're going to receive the same exact payment multiple times. And that's what's going to happen here. I'm going to get that 6,000 every year for 3 years. So let's put in what I know. I know the payment is going to be 6,000. I don't know the factor yet, but I know my N is 3 and my percentage is 12%. You always, always, always use the effective rate. That's why we scribbled out the other rate. Now to figure out what this PVA factor is, we need to go to a present value of an annuity table. And I'm going to pull one up, and I apologize, the copy is not the best here, but you have one in your financial accounting textbook. Most of them talk about this stuff in chapter 6, so it's probably at the end of chapter 6. But let me transition here. This is a present value table, and you can see right up here, this is present value of $1. That's not what we want. We're looking for an annuity. So I'm going to scroll down, or flip the page if I was using a textbook. You can see here's the present value of an annuity. That's what I'm looking for. I'm going to go down just a bit further. There we go. So here's my table. And what I want to do is I want to find the N down here. So the different rows are the different N's. And then I'm going to scroll across or move my cursor across until I find the percentage. So we have 3, that's this row, and 12%. So I want this factor right here, 2.40183. So let's go back to our problem, and we're going to put that factor in right here. And now it's just simple multiplication. 6,000 times 2.40183 gives me 14,411. So that series of interest payments at 12% interest is worth today $14,000. Not the 18,000, 6,000 times 3, but 14,400 when we account again for inflation, risk, and the inconvenience of not having that money to invest somewhere else. Now that I've got the present value of the interest, the next thing I want is to get the present value of the 60,000. I'm going to get that in 3 years. So present value of principal, or the face value, however you want to say it, is going to be that face value times the present value of it, not of an annuity this time, just of a lump sum, because I'm only going to get it once. To be an annuity, you have to get it multiple times. I'm only going to get the 60,000 one time. Same in, same percentage. So in this case, our face value is 60,000. I don't know the present value factor yet, but I do know that the N is still 3, the interest rate is 12%, and now I can go back to my tables and get that value. So let's go back to our tables. This is an annuity table, so I'm going to scroll up. Present value of $1. That's the way most tables show this is a one-time deal. You can also look for present value of a lump sum. That's the other way you'll see it. All right, so same thing. So 3 is my N, so I'm going to go down to row 3, and then across to column 12%, and that's this value, 0.71178. And now that I know that, I can put that into Excel, or into my problem. There are a lot of present value tables out there. If you were to Google present value tables, you'd get a ton of them. Let me just warn you, you want one with at least 5 decimal places. You'll find them with 3 or 4, but you want at least 5. If you use just 3 decimal places, 4 decimal places, the rounding is so bad compared to Excel or a financial calculator that you're just not going to get good numbers. So I strongly recommend that you use at least 5 decimal places, or even better, either do it in Excel or do it with a financial calculator. So now that we've got these two values, the present value of my note, the whole thing, will be the present value of the interest plus the present value of the principal. So the interest was 14,411. The principal is 42,707. So overall, this is worth $57,118 to Jones Company. I want to take just a second here to talk about the differences, or one of the key differences, between accounting and finance. And I'm not going to take a lot of time on this. It's an accounting class, not a finance class, but just to show the difference between the people you'll be working with, because chances are you'll work with accountants and finance people all together in one big department, or you'll be working with them as an auditor coming in, etc. The finance question here is, what do I do? Do I buy the investment or not? See, the time value calculations are exactly the same, But from finance's perspective, it's do I invest or not? I think it's worth $57,000 and change. If I can buy it for 57 or less, I'll do it. If it's selling on the market for 58,000 or that's all this company will take, then I'll walk away. It's not worth it. That's the finance question. The accounting question is different. We assume the purchase has been made, the money has been loaned out. My question from accounting is, how do I record it and how do I amortize the discount away until I get to the face value? So that's the difference between the two disciplines, is what question we ask after we've done the calculation. Now, before we go into the accounting question, how do I do the journal entry, which I'm chomping at the bit for, I'm ready to do a journal entry. But the big thing we do before we even move into that journal entry is we check this number. And the question is this the discount that we thought it was going to be? Well, the face value is 60. I think it's worth 57. That's all I'm going to pay for it. That's less than 60,000, so it is a discount. So I'm okay. I strongly recommend, anytime you do present value, that you go through that process. I decide whether it's going to be a premium or discount up front, and then I check when I'm done with my calculation. You see, the most common mistake here is that you flip-flop the two interest rates, stated rate and effective or market rate. And if you flip-flop them, you'll get the opposite answer. So I think it should be a discount. It comes at a premium. Oops, I got to go fix it. So keep that in mind, that this is just a quick check to keep you from making that most common mistake. Now that I've got my number, again from accounting, I'm assuming I bought it for that amount. So cash went out of $57,118. I'm going to get eventually $60,000. So that's what I'm going to put into my notes receivable. The difference goes into a cleverly named account. Remember accounting and our clever names, called discounts. And I'm going to put the balance into the discount account. And now I need a description. Purchase of a $60,000 3-year 10% annual note receivable at 12%. Now you probably notice I put in a lot more detail than I normally did with the description, and that's because I want to make sure that I have the details I need later as I do the rest of my journal entries associated with the note. Now that I've got the journal entry for issuing the note, now the next step is to do the journal entries for the interest payments. When they make a payment, we know how much cash we're going to get. It was a set amount. It's 10% of the $60,000. So I'm going to get cash of $6,000. The question is, how much interest revenue do I record, and how much of the discount do I get rid of? Because remember, I have to get rid of that discount little by little over the life of this note. So I need to add a couple of account titles here, and I'm not sure how much yet. But I know I'm going to record some interest revenue. And the way we figure out how much interest revenue for most companies, most loans, or bonds, or whatever the instrument is using the effective interest method. Now you can use the straight line method. We talked about that before. We take that whole discount or premium, you divide it by the number of payments, so we divide by 3 in this case. But FASB kind of frowns on that method, so we don't see it as often. So let's put a description. This is to received first interest payment, and we're going to do our calculation. And the way we do the calculation is we take the face value minus the discount, or plus the premium if it had come out the other way. $60,000 is our face value. Our discount is this amount, so $2,882. So our carrying value is $57,118. And if you've done it right, it'll match up to the cash that you got in that first journal entry. Now I'm going to multiply that by the effective or market rate, hence the name, effective interest method, use the effective interest rate. So in this case that's 12%, and that's going to give us our interest revenue. So if I multiply that out, and I'm just going to round to the nearest dollar, 68.54, and that's going to go up here. Now, I don't balance And that's the whole idea. Because I don't balance, my plug figure is going to go to that discount account. And that's how I'm going to get rid of my discount. So let's do a T account so we can see what's going on. Here's my discount account, and we started out with a credit of $2,882. The goal, remember, is to get this to zero. So if I want to have a credit balance, I want it to go to zero, I need a bunch of debits. So here's my first debit. And now my discount has dropped to $2,028. And if you've done this right, you see the discount drop over time. So that's my first payment. Now let's take a look at our second payment. Process is going to be exactly the same, only the numbers are going to change. In this case, again, I'm going to get $6,000 worth of cash. That's in the contract. I know I'm going to get rid of some of the discount. And I'm going to record some interest revenue. This is our second payment. And the calculations are the same. Face value, $60,000. Minus the discount, again it would be plus a premium, but my discount isn't $2,882 anymore, it's now $2,028. So I have a new carrying value of $57,972. I'm going to multiply that again by my effective rate, 12%, and that gives me interest revenue of $69.57, again rounding to the nearest dollar. And there's my discount amount. That's what I'm amortizing away this period. So let's go back, get our T account updated. $957. So I have a new balance of $1,071 in my T account. Same exact process for our third payment. Why don't you go ahead and pause it here and give it a try. Let's go ahead then and we'll do this payment together and check your numbers. You should have ended up cash of $6,000, discount of $1,071, and interest revenue of $7,071. This is the third payment, and here are our calculations. I'm not going to label everything, I'm just going to put them in. Since you've done this already. And if we've done it right, then when we go back, that's just what we wanted, and that's just what we got, is we got a zero balance in that account. Since we got a zero balance, then we can just slip in here the last entry. We'd receive this last interest payment and the final payment on this note at the same time. So let's go ahead and do the journal entry to show the payment of that note receivable. Final payment on note. And now the account is closed, the discount's gone, the premium would be gone same way, and I'm good to go. We've gone much longer than I wanted to, but let me take just a second to wrap up this discussion of notes receivable. First, sometimes we have to write off notes receivable just like we do accounts receivable, because people are going to rip us off. It's just the way it is. The method for short-term notes is exactly the same as the method that we use for accounts receivable. We have a allowance for bad debt account, we have a bad debt expense account. Sometimes we lump the expenses together, but we keep a separate allowance for accounts and notes receivable. With our long-term notes receivable, though, it's a little bit different. Instead of recording a bad debt expense each period, we go through every once in a while and we do what's called an impairment test, where we test the note and all of the notes in our portfolio really, and decide whether or not it's going to stay at the same value it's currently got, or whether we're going to get less than we expect. And if we think it's going to be less, then we drop the value of that note. We don't do it with an allowance and a bad debt expense. Instead, we actually write down the note and we record a loss, because it's a not as common an issue as it is when we write off an account receivable. I mean, that happens all the time. Notes receivable, since it's a formal contract, usually they get paid a little bit better. So we don't have to worry about that as much. One last thing, and then we're going to be done with this, and that is the IFRS for notes receivable. Treatment is very similar. Only difference really is that under US GAAP, you have the option. You can use straight line or effective, but we prefer effective. Under IFRS, you have to use effective. You can't even use the straight line method. Last difference is that, again, under IFRS, if we write down or impair a note receivable and then later on think we're going to get the full amount, we can write it back up. Under US GAAP, you can't do that. Once it's down, it stays at that lower value. We've gone a little bit long in this segment, and I apologize for that, but I got going on journal entries. I had to do them. We had to see it all come together. Now, though, we're going to take a bit of a break. When we come back, we'll start talking about other things we can do with our receivables other than simply collecting them. There's actually a couple more options that we're going to see, and I'll see you then.